right, then we'll get going now today. So thank you all for joining me. Today we're going to speak about a very interesting topic, and it happens to be a topic that there's a lot of talking around. So it's ERTC, which is the Employee Retention Tax Credit, and FFCRA, the Families First Coronavirus Response Act. Now, the reason that you may be hearing about ERTC in the news, this is not to discourage you from filing for this tax credit, but I would like to just give a little bit of explanation as to what's happening now in the nation with ERTC. So ERTC has existed. It is a tax credit. We'll go into the timetable, but the bottom line is that there are many predatory companies who, since the beginning of ERTC, have been reaching out to business owners nationwide, promising them that they qualify for ERTC regardless of circumstances. And you and your business, you may have yourself receive some of these phone calls from these really aggressive predatory companies. And what they did, again, is they promised every business that they spoke to that they could qualify. And in many instances, businesses did apply for the credit who were not technically eligible. And what happened is that the IRS did issue checks to a large number of businesses that technically were not entitled to the ERTC. So they did not meet the eligibility requirements. Now, what that means is that the IRS has now instituted, there are a couple changes with ERTC. One, if you're joining us today and you happen to have already received ERTC, or you have a pending claim and you've heard about these circumstances that IRS's, the red flags have been raised with the IRS. At the very end of the program, I am going to discuss what is called the ERTC Voluntary Disclosure Program, as well as ERTC Withdrawal. And those two programs exist for businesses that either already received credits and think that they may not have been qualified, or businesses that have a claim, a credit in process, either haven't yet received their checks or haven't cashed their checks. The IRS is giving individuals the opportunity to basically either repay a portion of the check of the funds that they received, or stop everything completely if they haven't already cashed a check. So that's not to scare you away from ERTC by any means, but I did want to set the stage just so everyone understands. If you are someone that would be interested in the voluntary disclosure or the withdrawal program, I'm going to ask you to please hang in there with us throughout the presentation. And at the very end, we are going to take questions. I'm going to ask that questions go in the chat, but I can go into far greater detail about voluntary disclosure and withdrawal. So if you happen to be on this meeting and you have already been involved in ERTC and are now potentially questioning your eligibility, by all means, hang out with me. Okay, just bear with me, sit with us through the presentation, and we will do our best to answer any questions that you may have about that. So we're just going to do a quick disclaimer. So the information that is contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but it does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and the receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited, and only non-commercial use of the material is allowed. All right, so today's conversation, right, we're going to talk about the two tax credit programs. So we are going to speak about what is FFCRA leave, how do you claim it, what is the employee retention tax credit, how does it work? So we'll, in the next couple slides, I'll talk to you about time ranges, but just keep in mind that these were programs that existed to address payroll that existed during the most difficult times of the pandemic. So the idea being is that both of these programs you would be able to file for credits that come back to you in the form of checks. But it is based on payroll. We'll go over the time periods in which it was based on. But just letting everyone know right from the start that this is or these are credits that would be received back from the IRS in the form of checks. But we're going to start today with the FFCRA. All right, so the FFCRA, Families First Coronavirus Response Act, basically it was created to help small businesses who had situations with either ownership or employees, and that's different than the ERTC you're going to see. But FFCRA, what it includes is that if from the time period of basically March 15th, 2020 through March 31st, 2021, if you or your employees had any specific COVID circumstances, which we will detail what they are, that involved COVID, we'll say COVID illness, quarantine, having to care for a family member, or having a child that was home from school, you could potentially receive a portion of wages for any individual that fell under those circumstances if they were paid. So the idea being is that, hey, if someone were to have had an absenteeism at that time period, they could receive, the business would receive a credit, of payroll up to 80 hours from the dates of March 15th, 2020 through March 31st, 2021. And then they could claim another 80 hours in wages from April 1st, 2021 through September 30th, 2021. So in effect, it is basically saying that we know that employers paid their employees for time that they were unable to work due to the COVID-related circumstances, and it is trying to put those wages back into the pocket of the business owner. So you'll see that it only includes up to 500 employees, and it is also available for sole proprietors. So you do not have to have an LLC or a corporation. You don't have to have W-2 employees to participate. All right, so COVID illness or quarantine, those are the two main reasons that most individuals were out due during those two time periods, right? So basically what it would allow is, if I'll just review the circumstances again. If you had COVID, if you quarantined due to COVID exposure, if you stayed home to care for an immediate family member who was exposed, who had COVID, or if you had to stay home to either homeschool a child or the child's school was closed, there are credits allowed under the FFCRA. So we're showing here, what does that look like if you happen to actually either have had COVID, you or your employees, or had to quarantine due to COVID exposure. So basically what it is that we can get up to $511 per day, which basically, that when we say up to, what we're talking about are the wages that would equal 80 hours. Okay, so at the most per day would be $511. So if we're talking about 80 hours, we're talking about 10 business days. They're basing this on 8-hour business days. So when we look at this, we know that if you had an employee who during the time period, the two time periods, right? One, March 15th, 2020 through April 31st, March 31st, 2021, and then April 1st, 2021 through September 30th, 2021. If we had that situation, they would be able to claim 80 hours in each time period for their pay up to $511 per day. Now, if they cared for a relative that had COVID, you can only claim up to 2/3 of the daily wages, which would only be allowed up to $200 a day. So if we think of a set of circumstances for FFCRA, if I had an employee that was out for 2 weeks, how would I calculate? Well, I would take their hourly rate and I would multiply it. Remember, I can only do it for up to 80 hours. In this instance, that employee was out for 2 weeks, 10 business days equals 80 hours, and I would multiply their wages per hour by the 80 hours, and that would be the credit for that employee or for myself if the people involved are W-2 employees. If you are a sole proprietor, we'll discuss a little later on how you would go about handling that. But basically, it's for anyone paid by W-2 wages. You're taking the hourly wage and you're multiplying that by the number of hours that they were out due to having COVID or having to quarantine due to COVID. Now, if we had somebody who had to stay home to care for an immediate family member for a relative who had COVID, you can only receive up to 2/3 pay. So you would take the hourly wage, you would only claim 2/3 of that hourly wage up to the amount of hours up to a maximum of $200 a day. So basically, we have those two different types of credits that can be applied for there. Again, those 80 hours are split into 2 time periods. So 80 hours from March 15th, 2020 through March 31st, 2021, and then another 80 hours from April 1st, 2021 through September 30th, 2021. So in effect, we basically the same employee could qualify twice if they had time facing those circumstances during the first period and then again the second period. So you could claim the same employee twice. However, they would need to have had those 2 separate circumstances happen, one in one time period, one in the other. So that's if we basically are had COVID, quarantined due to COVID, or cared for a family member with COVID. Now, if you had a child who was out of school, either being homeschooled or the school was closed when it would normally have been open, so it includes remote schooling, is absolutely included. It's very similar to the if you were home caring for a family member, in the fact that it's 2/3 pay up to $200 a day. However, that could be anywhere up to within 10 weeks. So it can be up to 10 weeks. It can be intermittent. It doesn't have to be the same, same stretch of time. So it could be a couple of days here and a couple of days there. Again, this would be for W-2 employees only, basically because when we talk about what will happen with our sole proprietors, it is calculated a little differently. So this is the credit for caring for children out of school. Now, if your children happen to be out of school and you cared for them in your program, technically that is not covered. But for the most part, when schools were closed, people were unable to work and had to stay home to care for their children. That's why that credit exists. So how do we claim that benefit? So how do we claim the credit? So here are the reasons. Here are the ways, excuse me. What we recommend is that you run the payroll reports, you identify the hours and the days that the employees were out due to those circumstances, and you document that. Your best documentation most likely would be your payroll reports and a spreadsheet. So I would make a spreadsheet that had my employee's name, the dates that they were out, their hourly wage, and the amount of, and the time period, time period and the reason that they were out. So name, time period, number of hours, the hourly wage, and then the reason they were out, right? And we need to use the reason we were out has to be there because is it 100% because they had COVID or they were quarantining due to COVID? Or did they have, or did they have to care for a family member? Or did they have to stay home for homeschooling, right? Those are not 100% of the hourly wages. They're only 2/3 of the wages. So we make that calculation, we pull the payroll report, we make the spreadsheet, and then the next thing that we do is if we have W-2 employees or ourselves or paid via W-2, you're going to be filling out a 941X quarterly. So you add up all of the employees in the correct quarter and you fill out a 941X for the quarter during which that absenteeism occurred, right? So let's say that I had an absenteeism in September of 2021. Well, that September is included in quarter three. So in quarter three, I would be filing a 941X for quarter three, 2021, right? So you're going to file that wherever the employees were out in that quarter. So when you look at your payroll and you look at the absenteeism, think of it in quarters. So you have the quarter that starts March 15th, 2020 through March 30th, 2020, right? So that's the very, very end of Q1. Then it picks up for Q2, right? April through June. And then it picks up again in July through September, and then so on and so on, October through December. So when you fill out the 941X form, you're going to fill it out for the appropriate quarter in which the employee had that absenteeism, and those are filled out individually and mailed individually to the IRS. All right. Now, when it comes to sole proprietors, the sole proprietors actually they're going to file an amendment on your 1040 form, which is a 1040X. And where the amount that you pay yourself comes from is not the hourly wage that you pay, but instead it is based on line 31 of your Schedule C. So whatever that amount is, you're going to calculate what your hourly payroll would be from that. Your hourly wage would be from that number. So the IRS basically, as a sole proprietor, has you look at line 31, which is that your net profit for that particular year, and you take that number and you do the calculation so that you determine how much an hour you would be paying yourself. And then you multiply that by the number of hours that you were out. And you would be amending your 1040. So that's the difference. If a sole proprietor were to pay themselves $25 an hour, but unfortunately their Schedule C does not reflect that same type of hourly wage, you can only pay yourself what is reflected in your Schedule C. So you'll just want to keep that in mind, how you're going to go about calculating that rate on there. You would receive a check from the IRS. It takes a very long time to receive those checks. So at one point last year, it was 6 to 9 months for people to receive the checks. I'm not sure, I can't tell you how long it is. It is now. Basically, you are able to file up to 3 years after, or 5 years, excuse me, after the date in which the situation occurred. So we're coming up now on the deadline for 2020. So basically what would happen is that we would need 2020, it is 3 years, I apologize, 3 years. So what would happen is that we would need anything that happened in 2020, we would need to file this tax season. Anything that happened in 2021, we would need to file by the 2025 tax season. So just kind of keep that in mind. If you were filing FFCRA for any time period during 2020, you are coming up on the deadline for filing. And then you would have, for all of 2021, you would have until 2025. I will say that that is subject to change. And the reason that I bring that up is based on what we're going to talk about next with the Employee Retention Tax Credit. So this is the Families First Coronavirus Response Act, FFCRA. Next, let's talk about the ERTC. All right, so the Employee Retention Tax Credit. You'll note here that it does say that it is easier than PPP. What does that mean? You are not applying for a loan, waiting for approval, or anything of that nature. So it is not anything. It will result in credits that come back to you in the amount of a check. There's no having to go through a loan process, and the money would not be repaid. Easier than PPP. It's based around your W-2 payroll, and this happens to be similar time period, March 13th, 2020 through September 30th, 2021. Now, it is including W-2 employees, but it cannot include ownership and family members of ownership. So you want to keep that in mind. When you receive that money, there are no limitations on how you could spend that money. So basically, unlike PPP, right, where we could only use that for certain purposes, when it was a loan and then eventually forgiven, right? But with ERTC, you can spend those funds however you would like. So you want to keep that in mind. Now you'll see on the screen, there's a notation here, special consideration for recovery startup. What is a recovery startup? Well, recovery startup is a business that opened anywhere from after February 15th, 2020 through September 30th, 2021. If that's the case, if they happen to have opened during that time period, the business would be able to claim a credit for Q3 and Q4 of 2021. So if you're on this, viewing this meeting and participating, and you opened a new business, keep in mind that we're going to talk about eligibility on the next slide, but in this instance, anyone opening a new business from that time period would be eligible for credit for Q3 and 4 of 2021. And that's the only time that Q4 2021 payroll comes into effect, because for everyone else, it runs from March 13th, 2020 through September 30th, 2021, and credit would not be received for the fourth quarter. So you just want to keep that in mind there. Now, we will go into all of the details about how you go about eligibility. Now, what I want to stress is, as I said in the very, very beginning, there were predatory companies. There are still predatory companies telling businesses that they can qualify regardless of their circumstances, or really stretching the rules, stretching the reasons for eligibility. And that is now being discovered by the IRS, that this is what occurred. It really has been a travesty in the fact that it's put a lot of hope into the hearts of business owners that they did qualify and the rules were bent. Why did those companies do that? Well, for signing, businesses had to agree that they would give up a certain percentage of their credit to one of those predatory companies. And it could be anywhere from 15 to 25% of their credit. The company that filed for you gets to retain that. So they basically have it is in their best interest to make sure that to tell everybody that they qualified. However, they're not the ones that make that decision. So let's look at what the actual eligibility is, okay? So in terms of eligibility, the first and most common one and the easiest to prove is revenue reduction, all right? So what happens is we think of that time period from March 13th, 2020 through those time periods through September 30th, 2021, quarter by quarter, we look at our gross revenue. It has to include any funding that you received. So any of the stabilization grants, any funding that you happen to receive must be included in that revenue. So what you do is that you gather your revenue for 2019, and 2019 becomes the baseline. So we have that revenue for 2019. We're then going to get the same quarters in 2020 and 2021, and we're going to compare those quarters against 2019. And what we're looking for is what percentage of revenue reduction did you have during the quarter, each quarter compared with 2019. In 2020, you were required to have a 50% reduction in one quarter to trigger or start ERTC eligibility. So when we look at calculations, the first thing we do is we look at revenue and say, hey, when did I have a 50% or greater reduction in revenue? That starts in 2020, that starts ERTC. Now, the quarters after that in 2020 only have to have a 20% decline in revenue. So we need that at least 50% to get started. And then the quarters that follow it, I would need to have a reduction in revenue of at least 20% for those quarters to continue to qualify. There's an interesting circumstance in that if you happen to have a quarter, there's what I call a bonus quarter, but I don't know the actual name of it. But let's say that I qualified in quarter 2 of 2020. I had a 56% reduction in revenue. And then in quarter 3, in quarter 3, I only had a 25% reduction in revenue. But hey, fantastic, I still qualify. Now, in quarter 4, I had an increase, 10%, and certainly, right, 10% increase is less than the 20% decrease that's required. But the rule is that I am eligible to take that quarter as being eligible because it followed the last quarter that I was qualified for. So there's that's why I call it a little bonus quarter, right? So we get the quarters that we have the revenue reduction, and then the quarter immediately following the last quarter that we had revenue reduction, we're now able to take that quarter as well. So that's the first way in 2020. Yes, in 2020, that's the way that the calculations worked. In 2021, we didn't have to start with 50%. We only needed a 20% reduction when comparing our revenue to 2019. So we're not comparing 2021 to 2020. We're going back to 2019. We're comparing that revenue. But in 2021, the rule was a little easier. So we only needed a 20% reduction to trigger ERTC, and the same circumstances apply up till September 30th, 2021, is that we could qualify, let's say we qualified quarter 1, we qualified quarter 2, quarter 3, I didn't qualify, I only had a 10% decrease, not a 20%, but that's the quarter that followed the last eligible quarter. Therefore, I get to take it as my bonus quarter, right? So I get to claim that credit as well. So revenue reduction, by all means, is the easiest to prove. And the reason for that is that the IRS knows what your revenue is. They know what your revenue is every single year. They can go back and they can reference it. We're talking about gross revenue. Those are the numbers that are reported to the IRS. They have that information. There's no playing around with that. That's very, very cut and dry, straightforward. So revenue reduction would be the first way that you would qualify. Now, the next way, which is what's considered to be a partial business cessation or a mandatory closure, is a little harder for someone to prove. And this is where the majority of those predatory companies took advantage and bent the rules and did some misinterpretation of eligibility. How did that happen? Well, the rule with this is that there needed to be a government order, either state or local, that caused you to have at least a 10% reduction in capacity or the ability to increase your revenue. So if there's something existed that was a government order, not a suggestion, and in this instance, what would that have been the case? Well, let's say circumstances are that your classroom size was limited. So your capacity was cut. Well, was it cut so much that your revenue declined 10% or greater? If that was the case, you would be eligible during that quarter. And that would continue. You would look at that eligibility to see how did that government order affect you. So it could be the capacity. If you were only allowed to care for the children of essential workers, that affected your revenue. Did it affect the children that you care for? Did it affect it by at least 10%? If so, again, there would be eligibility. So where does the difficulty lie in the entire government order, state government order? So what had happened was these predatory companies would look at things and say, hey, you had to provide hand sanitizer. There were parents that didn't want you to provide hand sanitizer. There were parents that didn't want you to wear masks. You were supposed to wear masks. That affected your revenue. It affected your ability to increase your revenue. A ridiculous one that I heard is that parents had to pick up their children at curbside, and some parents didn't want to do that. If they couldn't come in the building, they weren't sending their children to school. Therefore, reduction. Well, first of all, was it mandatory? And even if it was mandatory, did it affect, was it a government? So if it was a government order, you don't want to play around with that type of eligibility. A parent deciding that they don't want to bring a child is very, very different than a government order that says you cannot take more than this number of children, or we can only care for the children of essential workers. And government orders, what was happening with these predatory companies is they were filing and doing calculations based on this ridiculous idea that all of these little intricacies counted as the possibility of reducing the capacity and reducing the ability to increase your revenue. They were all bending the rules. In those instances, many, many thousands and thousands of checks were issued. And now the IRS is going back to those businesses and reclaiming those funds. So that's very, very scary. So there's a lot to be careful with when it comes to a state or local government order. If you believe that you had one, find the documentation, read it through, find the start date and the end date, which isn't as easy as it seems. Sometimes you'll do a search online and you can never find the real end date. The other thing that has happened is that there would be an order in place, what appears to be an order, and then at the very end of it, it says, as suggested, right? So it takes this whole, gives you the whole thing, and then at the end of it says, as suggested. That's not an order. That's not a requirement for you to follow all of these things that they've listed. Be very, very careful if you're going to claim ERTC as qualifying as a state or government order that limited your ability to increase your revenue by at least 10%. So please be careful with that, because that's where we're seeing the most amount of audits occurring. That it was very, unfortunately, really some individuals received incorrect information. So it's really, really unfortunate. All right, so the last thing we had discussed briefly, recovery startup. So if you have a business that started, a new business started after February 15th, 2020, or anywhere after February 15th, 2020 through September 30th, 2021, that had less than $1 million in annual revenue, you would be eligible for credits of up to $50,000 for Q3 2021 and Q4 2021 payroll. All right, so keeping that in mind, again, this is something that is very easily documented by the IRS. They know when a business started, and if a business started in that time period, you do not have to meet a decline in revenue. You do not have to meet a government order. Just by opening a business during the most difficult times of the pandemic, you are eligible for that credit. Again, up to $50,000 of credit per quarter for quarters 3 and 4 in 2021. So that is recovery startup. So it is a little different than the other circumstances, in that this is the only time that you would ever be claiming payroll from Q4 of 2021, right? For everyone else, that program ended September 30th, 2021. But in the instance of recovery startup, you were able to go ahead and claim those credits. All right, so what exactly is the benefit? Before I jump into there, I want to explain how you would go about calculating that benefit. So what you would want to do is you determine what quarters you're eligible for. There are some things that you have to do. So we determine the quarters we're eligible for. We run that payroll by employee, and I'll explain why in the next slide, but we're going to run it by employee. And then we take that payroll and we're going to back out any time period that was covered by PPP. So if I had a PPP loan that started June 1st, 2020 and went through September 30th, 2021, I am not going to claim any payroll during that time period. So I'm going to take out that payroll. Once I've made that adjustment for PPP, I'm going to remove the payroll for any family members and any owners and family members of owners. So we're going to pull that out. What that gives us at the end of the day is the gross, basically our gross payroll that we can use to calculate the credit. So there are, in 2020, the rule is that we could only claim up to 10,000, well, we could only have payroll of up to $10,000 in wages for all of 2020. So if I have an employee who earned $5,000 per quarter, I was eligible, let's say, for all 3 quarters in 2020, well, I can only take $10,000 of those wages, not the $15,000. I can only take the $10,000 in wages. And in 2020, the credit was 50% of those final wages, right? So 50% of up to $10,000. So if I had an employee that earned $10,000 in 2020, great, I could take 50% of that and receive that credit for that employee, right? So as it says here on the slide, the 2020 per employee annual maximum, $5,000, right? Because the most amount of payroll we can claim is $10,000, and we take 50% of that. That's the rule in 2020. Now let's take a look at 2021. So in 2021, the benefit became a little more friendly, right? So we're talking about January 1st, 2021 through September 30th, 2021. We still run that payroll, we pull out that PPP, we pull out ownership and family members of ownership, and the gross payroll that remains, we are actually able to get a credit on $10,000 in employee wages per employee per quarter. So not for all of 2021, per quarter. So that actually means that we're allowed to include a lot more payroll in 2021 than we were in 2020. So the actual percentage of that payroll that we're able to receive a credit on, that also increased. So in 2020, I could only claim 50% of my payroll. In 2021, 70% of the payroll. So what does that mean? If each quarter I can claim up to $10,000 in wages per employee, fantastic, and I get to take 70% of those $10,000 in wages, the maximum per employee that I could end up earning would be, that I could receive credit on, would be $7,000. So per employee, $7,000 per quarter. So that means in 2021, the maximum amount of credit that I could receive for an employee was $21,000. Now remember, let's go back to 2020. The maximum that I could receive was $5,000 in credit, right? Because there was that $10,000 cap for all of 2020 for my employees. So that comes to $26,000 per employee. That number might ring a bell with you, all right? And the reason that it may trigger some, I've heard that before, is because when those predatory companies reached out to everyone, they used the number of up to $26,000 per employee. You can receive $26,000 per employee. That's where they got that number from. So when someone from one of those predatory companies approaches you, they're probably going to they're going to dangle that $26,000 per employee out there and say, this is what you could be eligible for. Now, obviously, it's based on what your actual payroll was, but that's kind of how they reel you in. They hang that $26,000 over your head, and it's a lot of money to walk away from, right? So everybody then starts to believe the predatory companies that they are eligible and that they could make this little exception. Yesterday, the owner of Civitas Strategies and we were going through, somebody sent us the letter that the predatory company sent them telling them how they would be eligible. And it was absolutely ridiculous. It was just one lie after the other. Well, what's going to happen is that eventually, let's say that business got those checks. Although right now, since the IRS is so on to everybody, they're stopping this stuff dead in its tracks. But you file the claim, you don't want to ever be considered to be filing a fraudulent claim. But what those companies do is they take that percentage of that, anywhere from 15 to 25% of your credit, and then we don't expect them to be around much longer. You're not, what you sign, you're not going to be able to get your money back from those businesses if you were audited, if you had to repay a credit, that's gone. So you could, before this new voluntary disclosure program that we'll discuss at the very, very end, you could actually be eligible to repay the entire amount, even though you only got to keep whatever was less their fee. So just, again, being very, very cautious. It's not that it was difficult to receive, and not that it is difficult to receive ERTC. And I don't want to discourage anyone from applying if they meet the eligibility, but no bending of the rules, no open to interpretation, none of that, because then you will find yourself in exactly the circumstances that these thousands and thousands of businesses are falling into, where they now have to go ahead and repay this credit, right? So we could have people, we're talking in some instances, hundreds of thousands of dollars that they now need to repay. And it's scary, right? Again, not to say don't, not telling you don't go ahead and file for the credit, just make sure that you're truly, truly eligible. How do you end up getting that credit? Well, let's go to the next slide and take a look at that. All right, so it is considered to be self-certifying. Remember, the IRS knows everything about your revenue, and they have a list of every government order that existed. They know those circumstances. But what you need to do is you need to keep records of how you came about your calculation. So if we're talking about revenue reduction, you would keep records of 2019 versus 2020 and 2021. You would reflect the revenue reduction. Go ahead and keep that. You're going to run your payroll reports. You're going to keep copies of your payroll reports. When this slide says that it's self-certifying, what that means is that you're not sending that documentation to the IRS. All you'll be sending the IRS per quarter for the entire quarter for all of your employees, that credit would be the 941X form, which really amends your original 941 form. So 941X, it's not difficult to fill out. You'll see the note here, contact your payroll company. It isn't difficult. If you actually Google well, actually, I'll give a plug for business coaching in a minute, because I can help. I can't do the calculation for you, but I can give you some counsel as well, or give you some education, I should say, excuse me, give you some education on it if you were to enroll in one-on-one coaching. And I can give you a document that explains, once again, how to perform the calculations. And then there's a link in my document that takes to a video I recorded that tells you how to fill out the 941X. So in a few slides, I'm going to share some QR codes with you, and one of them is for registering for ERTC business coaching that is brought to you for free on behalf of DECAL, conducted by Civitas Strategies. I'm one of the ERTC coaches. So you may want to get your phone out if this is something that you'd like to pursue more, and we're going to answer questions, but just kind of keep in mind that I do have directions that I could share with you that you could utilize to see if you did you qualify? How do I do my calculation? How do I file? So keep that in mind there. But again, contact your payroll company. Payroll companies, accountants, legitimate businesses also did 941 and continue to do 940, fill out 941Xs, but they also do ERTC calculations. But of course, you are going to pay them. The benefit being is that it is most likely a more legitimate company that will only give you, hopefully, the correct advice. But again, I'll show you the QR code where if you'd like to speak to me or one of my coworkers directly, we'd be happy to give you some ERTC counsel. I keep saying counsel, but it's only education. We don't do anything for you in terms of figuring out your eligibility. We don't do your calculations, but we certainly can give you the steps that you need to take to educate yourself on how to go about filing for the ERTC. So we talked about a lot of different information. You'll notice here, receive the check 6 to 9 months of processing. That's not, at least the last 2 years, that's no exaggeration. So, and my understanding is that it's almost impossible to find out where you are in the process. So, having said that, before we jump into questions, I'd like to just discuss again how in the very beginning of the presentation, we talked about the fact that now there are businesses where the IRS could potentially come back and ask for a repayment of your ERTC. There's a program called the Voluntary Disclosure Program. So the ERTC VDP. And what that is that is now giving business owners who have received in cash checks, regardless of when it was, could be way back, who now are acknowledging that, hey, I probably didn't qualify or my calculations were wrong. You've got, all of a sudden you realize, hey, something's a little hinky, something wasn't right. So what that entails is that you can apply for this program. You do have to pay back ERTC, but you only have to pay back 80% of that claim. And the reason for that is that the IRS is saying, hey, you don't have to repay the whole 100% of this because we're pretty sure you paid somebody to come up with these calculations, and we're saying that 20% of that was given to one of those predatory companies. So you only have to repay 80% of that. Now, the next program is what's called the ERTC withdrawal. So if you've filed a claim, filed your credits, and now you haven't received your checks, or you received your checks and you haven't cashed them, now would be a good time. If you have any hesitation, you can basically file for withdrawal, and that stops ERTC dead in its tracks. So again, if you haven't received your checks yet, or you received your checks and didn't cash them, withdrawal would be a good option for you if you have any doubts. It doesn't mean that you can't file for ERTC. It just means that, the circumstances are that a lot of businesses shouldn't have filed. So keep that in mind. The other circumstance that's happening now is very, very unique in the fact that there is a bill right now in government that would halt ERTC and would actually end the ability to file claims. Now that goes to vote on Monday. And in that bill, they actually, remember, now Monday is what, Monday is the 29th. They're actually suggesting that no ERTC claims be filed after the 31st of January, 2 to 3 days later. We have a feeling if it does pass that they will extend that. Perhaps you'll have another month, no promises, and the bill may not be passed at all. But right now, up for vote is the idea that ERTC comes to an end. And that has a lot to do with the fact that so many ineligible credits were issued, so much money was given out. So after today, I want you to keep in mind that, hey, this could be pending, this could be ending anytime now. And if you thought about the circumstances, qualifying circumstances, and you say, hey, I know for a fact that even given the addition of my funding, I still would have had that percentage, at least one quarter with 50% reduction in revenue versus 2019. In 2020, at least 20% reduction in revenue in 2021 versus 2019. If you feel very strongly that you had that situation, you still do have time to file, but it's very, very short if that bill goes through exactly as it's written. So today was a kind of an odd time to have the ERTC discussion, but it doesn't mean that the door is completely closed. So just like everybody to keep that in mind. The coaching that we do on ERTC, what I've done is I opened my calendar up. So instead of only being available a couple of hours I'm tomorrow I'm going to be open all morning, and then Monday and Tuesday and Wednesday, wherever my availability is. I would be happy to meet with you if I have any availability. If you have any questions about the ERTC, again, take out your phone because we're going to have some QR codes in just a moment. All right, so do we have any questions in the chat, Miss Margaret, or in the Q&A? I guess it's just chat in the meeting. I'll take a look too. Okay, so we're expected, Charmaine, right? We're expected to remember our employee absences from 2020 and 2021. They are counting on you having had payroll records that showed absences from 2020 and 2021. That's what they're counting on. But keep in mind, the ERTC was started very early in the pandemic when that was very much at the front of mind. Okay, so just keep that. And yes, it certainly seems a little crazy, right? That you'd be expected to remember that, but just kind of keeping that in mind. I don't see any other questions. So what we'll do is let me just jump to the reflection, and then I'll share QR codes, because the QR codes that I share are going to be for some really important resources that DECAL is bringing you. So hang in there with me for just another couple minutes. I know we're running out of time there, but remember, what was today about? It was to understand what ERTC is, what FFCRA is, what the differences are. Do these credits apply to your business? Do you have the documentation, and can you prepare the documentation that would be necessary to support your filing? And then you have to be prepared to file the 941X if you meet the eligibility requirements. So we do hope, of course, that this information was valuable to your business. And we look forward to seeing you again in another Thrive Childcare Business Academy topic. We do 2 of them a month, so we hope that you'll join us again. And please, we do encourage you to visit the website, the DECAL website. Just let's see here. Maybe Margaret, could you throw that in the chat? I'm not sure why that's not on the slide. Maybe it's on the very, very final slide. But really to take a look at the webinar dates and join us again. But I asked you to hang on for this. This is pretty interesting. All right, so we do. Will we have a certificate for this class? So yes, that's correct, Margaret. Right, we will be receiving. They registered for with their
Yes, you will receive 1 credit hour through your PDS account, and that should be awarded to you within 1 week of this training. We'll submit the attendance, and you will receive your credit hour.
Great, thanks, Margaret. Appreciate that. On there. So, all right, first thing up. Small group studies. What the heck is a small group study? So what it is, as it says, right, a small group of providers. You're brought together with a small group of providers to discuss the following topics. Different times. There's a lot of time availability for financial foundations, recruiting and retaining staff, mitigating risk, sales and marketing, revenue streams and growth. It's a chance to learn from a business leader, really coaches from Civitas, and then to learn from each other. So you get this small group together, they go over topics, you brainstorm. It's really, really interesting. So 4 virtual sessions for each topic. Each virtual session lasts an hour. Again, working with your peers and with this coach to really get to the bottom of these topics and really help give your business guidance. There's a workbook that you would use, and there's a little bit of homework, but it's nothing crazy there. So it's exciting, and you will see that once a topic is completed, you receive 4 PDS hours, right? So that's fantastic. But also, once a topic, which we call tracks, once those are complete, once one is completed, you receive a stipend of $300. So if you'd like to take out your phones now, this QR code will take you to the registration so that you can go ahead and sign up for the the small group studies. So really, really beneficial. And this is also posted on their website, which is decal.ga.gov/thriving. So just keep that in mind there. Let's see here, Miss Lisa James. I did a small group in December. Just got an email that I needed to fill out some paperwork. So, and thank you. Margaret has included the link if you don't have your phone out for the for the QR code, by all means there. So, and I needed to fill out some paper. Margaret, where should someone reach out to if they have a question about their small group study?
If you have a question about small groups, I will share the Georgia coaching email address in the chat, and that'll connect you with Ashley, and she'll be able to help you either find the form that you need to fill out or answer any questions that you have regarding that form and what information she might need.
That's great. Great. So our Margaret's going to put that in the chat for us right now. That's fantastic. So if you do have any questions regarding small group studies, if you go to the link that she's put in there to register, you have any questions, you've participated, by all means, please reach out to the email that Margaret is putting in the chat right now. I did see here, how do we know which classes are for the stipend? So my understanding is that it's each track is allowed for the stipend, but why? I think that might be a good idea, Lisa, to also send that as a question so that you can get clarification. All right, so let's get that there. Since Margaret has put the link in the chat, I'm just going to jump. I know we're, oh my goodness. Well, we started late, right? So I've got a little bit of time here. All right, the next one-on-one business coaching, okay? So the same topics that are covered by the in the small study groups are also available for one-on-one coaching: financial foundation, sales and marketing, recruitment, retention, revenue streams and growth, mitigating risk. The link for this is on the Georgia website so that you can register for the one-on-one coaching, as well as a QR code here. So I'll just keep that up for a moment. So again, free one-on-one, they're 30-minute phone sessions on any of the topics that would be included here. I will tell you that if you have something regarding your business growth and you're not sure if it falls under one of these topics, you can reach out to us through the scheduling link and suggest a different topic, and we can, hopefully, I can find a coach that can speak to you on that topic. One of the things not mentioned here that I have been speaking to individuals about is business structure and formation, so forming LLCs and things of that nature. So if you were interested in that, you certainly could use this QR code, and you can just make a notation that you're interested in business structure and formation or something along those lines. We'll do our best to get a coach for you within reason for certain topics there. So, all right, now that we've seen that, oops, I think I've got some things here for question. Oh, thank you, Margaret. Sorry, I'm just going through to make sure there. Okay, so this is tax education business coaching. I cannot pump this up enough. All right, so what is tax education business coaching? Again, free coaching. How does it work? Through a safe means, you send your 2022 business taxes, and then a coach such as myself, who's trained on tax education, goes through your 2022 taxes and looks for areas of opportunity. So maybe missed expenses. It's the first thing I look for. The second thing I look for is, was anything filed written in the incorrect place, entered in the incorrect place, that could cause a problem with the IRS, right? You want to know that now going into this tax season for your 2023 tax year, that everything is great. And then I also look for red flags. So I look for anything on your tax return that maybe you didn't have a problem with the IRS last year, but eventually you may. So I do look for these red flags. So really what it does is it helps you maximize your tax savings, because I'm looking for deductions and expenses that you haven't already taken, as well as helping you mitigate your risk, so that basically we can help you eliminate, or basically try to make it to eliminate any problems that you might have with the IRS based on your tax filings. We work with sole proprietors, and we do work with LLCs filing as S corps and single member LLCs as well. For sole proprietors, we go into the time space calculation and business use of home. We break it down. Here's a QR code for that. I highly recommend it. It will really help your business. It's very beneficial. Civitas does these across many states. So I've had nothing but really great success with it. Providers being very happy that they took the time to let us break down those 2022 taxes, take a deep dive, and figure out how we can help you prepare for your 2023 tax season. So, all right. Now here, my one-on-one ERTC FFCRA coaching happens to be with me. And so if you can't come away from this presentation with any questions whatsoever, by all means, scan the QR code. Let's meet for a 30-minute phone call, especially if you happen to perhaps have interest in the voluntary disclosure program or the withdrawal program. I can kind of talk you through some of the specifics of those, but also I'm not discouraging anyone filing for ERTC. And given the fact that we may, as of Monday, we may have a very short window of opportunity to file to get those 941Xs postmarked by the deadline. Again, I've opened up my schedule, so there should be some availability if anybody would like to meet with me about ERTC. FFCRA, you would go ahead and register. We actually do FFCRA coaching via email. We make it very easy for you. You answer some questions for us. We respond back and let you know what it is that you need to do. I give you instructions. Super simple. So that is ERTC and FFCRA coaching. So we'll go over that. And here's our thank you, right? So here is that website that Margaret was kind enough to share for us, the decal.ga.gov/thriving. There are self-study guides. You'll see all of the links for the webinars, and you can register for those small study groups. In terms of coaching, please use one of these QR codes, or I'm going to throw or maybe Margaret, could you just throw my email in the chat? So that if somebody did, thank you, I appreciate it. If somebody missed a QR code, has a question, you certainly are more than welcome to reach out to me. So you can reach out to me directly. So if you didn't want ERTC coaching, but you still had a one-off question, something we didn't get to today, by all means, please feel free to email me. Margaret's kind enough to put that in the chat for us, so it'll be there in just a second. And again, thank you. I know we ran a little over, so I do apologize. And I hope to see you at future webinars. I hope to hear from you very much for one-on-one coaching, ERTC coaching, tax education. Join the study groups, the small study groups. There's a heck of a lot to be learned through all of these resources, and they're provided free for you from Decal.